Well, hello everyone, and welcome. I'm Nathan Mangelsdorf, an associate in our commercial forensic division, and I've got Ashley Leslie here, a senior manager in our insolvency and reconstruction division. Today we're going to talk to you about some indicators of insolvency. So the topics today, I'm going to run you through just briefly what is insolvency, define insolvency for you, and give some primary warning signs of insolvency to look out for. Ashley's then going to take over and talk about some not so obvious signs of insolvency, some insolvency myths, and what to do if insolvency is suspected. I think it's probably a good mix having both Ash and myself here. Ash will sort of approach it more from perhaps from a more practical perspective of a liquidator, whereas my background is sort of preparing solvency reports for litigation purposes. So insolvency is set out by the Corporations Act and in almost identical terms under the Bankruptcy Act. The provisions don't actually limit what matters may be taken into account, but over time various case law has provided guidance as to how the Corps Act and the Bankruptcy Act will apply. Investigation into insolvency is centred upon when the company or person ceased being able to pay its debts as they needed to be paid. And it's that inability to pay the debts that's the significant part. So just because an entity wasn't paying its debts doesn't necessarily mean it was unable to do so and was insolvent. They may have decided not to pay for some other reason, such as a genuine dispute, for example. Now, the use of the words there in the Corps Act, as and when they become due and payable, suggests an emphasis on cash flows. And this is supported by case law, where a test of cash flows is intended over, say, a simple balance sheet test of whether assets exceed liabilities. But as I'll discuss later, the balance sheet position is still a very important indicator. Overall, insolvency is a question of fact to be determined by the financial position as a whole. A practical approach applying a degree of commercial reality is key. So broadly, some relevant things to consider when you're assessing insolvency are sort of your debts at the time. So due and payable debts stems from analysis of the liabilities of the business, obviously. Debts that are not due at that time, such as long-term liabilities, or debts that have not reached the end of their credit term, such as current trade debtors, trade creditors, for example, will not be considered due and payable. Most liabilities will eventually become due and payable, but it's the timing that's important. It's possible for an entity to, say, have more liabilities than assets, but not be insolvent if its debts are not all due and payable at that particular time. Relevant assets are those that can be used to satisfy debts, either immediately or within a reasonable time frame. Some assets are immediately available, like cash. Some may take some time, such as accounts receivable that have to be collected, or stock that has to be turned around and sold. If the asset can't be used to pay a debt, say a key piece of equipment for the business, it won't be a relevant resource. And in that way, sort of asset-rich entities can still be regarded as insolvent if its assets can't be used to pay a debt or be realised within a reasonable period to pay its liabilities. So a good understanding of the business operations at the time is really crucial in determining expected future cash flows. Also, arrangements between a company and prospective lenders or other sources of financing is very relevant, but we'll talk about more on that a bit later. So proving the date that an entity became insolvent is usually one of the most difficult and time-consuming tasks in any insolvent estate. As Ashley here will tell you, it can be one of the most expensive tasks to complete. But it's also one of the most necessary. For example, void transactions recovered by external administrators had to have happened when the company was insolvent. So this is why insolvency practitioners will spend a significant amount of time looking into the solvency question and ask creditors and banks to assist in providing information where possible. In its most simplistic form, the task is really mathematical. It's primarily a comparison of what resources were available to the company or person at the time and the debts that were due and payable. But in reality, the task is rarely that easy. Generally, many of the entities you're looking at have poor records or do not provide a clear or complete picture at all. So over time, through various case law, we've had some common indicators of warning signs of insolvency that have developed over time. They really are sort of common sense indicators if you look through that list in most cases. I've put most of them up there on the screen, but some tend to be more important than others, and I'll go into further detail on those. The important thing to remember is that they really are just that, indicators. It's not a mechanical checklist exercise. You may see some of them and not others. They shouldn't really take away from the primary question, which is could the entity pay its debts as and when they were due and payable. Nevertheless, they're handy red flags to watch out for. So your financial statement-based sort of indicators relate to information that's available in the business's books and records, or in many cases, the lack of that information, I suppose. Many times I've had to, and I'm sure Ashley probably has had to as well, completely rebuild the financial position of an entity in order to assess its solvency. So your financial statements, they should sort of provide sufficient information for business owners to determine the likelihood of insolvency, but in many instances financials are poorly produced, or the results are just ignored by the directors. So moving on to our indicators, continuing losses. Obviously making losses is a signpost that should alert business people to the possibility of insolvency. Not every business that makes a loss or even a series of losses is in danger of becoming insolvent. Typical example may be a construction or a project-based business where they can incur losses for extended periods with an eventual foreseen payoff at the end, I suppose. Normally you find those types of businesses are actually supported along the way by related entities. As long as working capital resources are available to absorb the losses, or like in many cases there is some external support, insolvency can be avoided or at least delayed. If losses are continually incurred, obviously working capital will eventually be depleted. So business owners need to consider available levels of working capital and the extent and timing to which they might be depleted. For many small businesses, even a short run of losses will deplete its resources and eliminate any capability of continuing to trade. As far as your liquidity ratios go, you generally look at the current ratio and sometimes the quick ratio, depending on the type of business that you're looking at. These give basically they give a good snapshot of the ability of the business to meet its short-term liabilities. You need to be a little careful whether the entity is actually classifying its assets and liabilities correctly as current or non-current, because it's something they tend to, you do see it done incorrectly. The courts will also distinguish between a temporary cash flow problem and what's called an endemic shortfall of working capital. There's a difference between the two. Keep in mind off-balance sheet items such as contingent or prospective liabilities. These will be assessed based on likelihood of becoming due and payable. You really need to have a good look at loan accounts or sort of bank guarantee obligations, for example. There can be all sorts of hidden gems that pop up out of nowhere that aren't necessarily sitting on your balance sheet. And it's worth also considering a more simple balance sheet test, which is basically whether assets exceed liabilities. Although the emphasis is on cash flow, the balance sheet test is still a very useful indicator. Obviously, with that comes the same sort of problems, relying on accurate financial data, values attributable to assets. Assets such as intangible property, goodwill, for example, are not going to be recoverable and able to be used to pay debts, for example. Overdue Commonwealth and state taxes is one that it pops up a fair bit. Many cash-strapped or unprofitable businesses regard withholding payment of tax commitments as probably the easiest way of generating essential cash flow. I know from my days as a tax accountant that many clients sort of see the ATO as just another provider of short-term financing, really. So the non-payment of sort of tax commitments, are they a good indicator of insolvency or not? And this goes for GST, PAYG, yearly income tax, stamp duty. The broad answer, yes, they are a good indicator. Unless there's a real dispute over the amount, most businesses will normally meet their obligations to the ATO when they're due. But you also need to consider payment arrangements that are made with the ATO, which are fairly common, as this may change the due and payable date, especially if there's a formal agreement in place. A poor relationship with the company's bank usually stems from some pretty fundamental issues. Not paying interest when due, placing the bank in a position where it regularly dishonours payments, for example, perhaps providing financial information to the bank which is incorrect or misleading. These can all lead to a poor relationship with the bank. And certainly if a bank refuses to advance further funds or calls up a loan or overdraft, the reasons for that action need to be looked into and established. Access to alternative finance and the ability to raise equity, this is actually often the most contentious aspect of insolvency, really, is whether the company had external support from its directors, its shareholders, or other related entities. The general idea is that, I guess, no, the business couldn't pay its debts when due and payable in its own right, but its director or shareholder was worth millions and would have paid anything that popped up. It's that sort of argument. And ultimately, it's really a question of fact, which is up to the court to determine. And historically, the courts have approached it with a degree of scepticism. It's a question of both willingness and ability of those parties to support the company. And that can it can turn into quite a complex legal argument. Additionally, funds may be obtained by, say, selling or mortgaging assets within a short period of time, as long as they're not essential to the business operations. We always review payments to creditors as well as correspondence. You can normally see patterns emerging of part payment of invoices. Sometimes the business resorts to making small payments to creditors, and those are usually in a round sum amount. It's normally a pretty good indication that cash flow is tight. And if the entity is sort of placed on cash on delivery terms, this sort of indicates the supplier has no faith in the customer's ability to meet future commitments. In general, business owners that are constantly attempting to piece together payment plans must sort of seriously consider the question of insolvency. We review aged creditors reports. As an entity with a range of creditors outstanding beyond agreed terms must be considered as a higher risk of being insolvent, and that conclusion is usually justified. And you can assess it over time, say month by month, and watch. You generally can see creditors start to blow out past 90 days. You should consider, though, whether the terms have changed through a formal payment arrangement. So reviewing any correspondence between the entity and its creditors as to whether they've agreed different terms is important. Regardless of the business structure, a lot of business is done by people dealing with people, really, and the relationship between the parties can dictate how business is conducted. Strained relationships often lead to or come from a strained business, and business owners can get an indication of the health of their business from the health of their relationships with the people they do business with. I've listed up there just some general principles from various case law where generally a course of dealings between the parties has had an effect on whether a debt was considered due or payable. Without going into detail on each one of them, it's suffice to say the courts have generally applied a commercial reality approach. When the bank repeatedly dishonours cheques or cash transfers, it indicates obviously insufficient funds to cover payments to an entity's creditors, and an inability, I guess, in general to meet all debts when they fall due. I've got up here the issue of post-dated cheques, although it's not so relevant now with electronic banking. Additionally, solicitors' letters, summonses, judgments or warrants issued against the company are relevant. We can do searches of the Federal Court of Australia or the Supreme Court, and you know, via the court websites, and see if there are any judgments or warrants outstanding. And just generally, they're an inability to produce timely and accurate financial information and make reliable forecasts. I suppose insolvency and having financial records in disarray often go hand in hand. Poor or inaccurate records can obviously be a fairly obvious indicator. I'm sure, Ash, you've dealt with that.
Yes. Quite often we find businesses with insufficient records. Some have never kept books and records. Some have never had computerised systems, even in this day and age. So we do come across a variety of ways that businesses manage or purport to manage their books and records.
Okay, well, I think that's it from me on the more standard sort of indicators of insolvency. I'm going to hand over to you, Ash, and
Thanks, Nathan. Yeah, the top 14 indicators that Nathan discussed are perhaps the most obvious indicators of potential insolvency. However, there are many signs that may point to an impending insolvency, with some of them not so obvious. For example, an absence of a business plan. Of the companies that we wound up, almost none have taken the time and the money to prepare a business plan. Without a plan, it is difficult for a business to measure both good and bad performance and to take appropriate steps either way. Put simply, a business that has no business plan has no plan to succeed at business. A lack of cash flow forecasts and other budgets is again a type of planning rarely seen in insolvent businesses. A lack of cash flow forecasts and budgets often results in a business overspending on non-essentials and falling short when it comes to paying its bills on time. A business will then try to find cash flow from other sources, namely by delaying paying employee superannuation and taxes, thinking that they'll catch them up once the cash flow improves. Often, though, the cash flow shortfalls continue to spiral out of control. So sticking closely to a carefully thought out budget and acting quickly and seeking advice when cash flow forecasts are off the mark will help to avoid cash flow issues from becoming unmanageable and permanent problems. When it comes to unrecoverable loans to associated parties, such as loans to directors, shareholders, other related parties, these are often seen on balance sheets of struggling businesses. The rule of paying dividends only from profits was created to ensure that stakeholders are not taking funds out of a company that the company needs in order to survive. The same general principle should be applied when it comes to loaning money to related parties. A loan that is given to a related party which has little or no prospect of ever being repaid should only be considered if the business is trading at a profit. And even then, the loan should never exceed likely profits to ensure desperately needed cash flow is not being redirected permanently away from the business. Where overdraft limits are reached or defaults on loan or interest payments have occurred, this is a sign that cash is well and truly running out. It is also a sign that a bank or financier may shortly step in to minimise their potential further losses. When it comes to board disputes and director resignations or loss of management personnel, this is often from the disagreement between key decision makers, and this indicates to us a lack of agreed direction for the business. It can be a sign, and quite often is, that things are very wrong and that the business is fast on its way to running off the rails. If you don't have any agreement between the decision makers, there can't possibly be an agreed way forward on how to deal with problems, and quite often then they're ignored. We often see directors have an expectation that the next big job or sale or contract was going to save the company, particularly in industries like construction that have been struggling for quite some time. However, more often than not, it's a sign that the cash is running out, if it hasn't already done so, and debts will at least be delayed if they're ever paid. It's often a sign that directors are burying their head in the sand, refusing to accept that their company is in desperate need of assistance, or in some cases already in need of winding up. Where a company is experiencing difficulties selling its stock or collecting debts owed to it, after cash, stock and debtors tend to be the most liquid of assets available to a business to pay its debts. Therefore, if a business is experiencing difficulty converting stock into cash and or is having issues collecting their debtors, then this clearly results in a cash flow problem, and that if remains unchecked will continue to worsen. Issues with collecting debtors also indicates that the business lacks some key control over its assets, which likely means a lack of control in other areas, and that particularly leads to delaying or non-payment of creditors on time. They often then seek extended payment terms with their creditors, when in fact they would be better off just giving some of their own debtors a call and following up payments. If a company has defaulted or is likely to default on its agreements with its financier, as previously discussed, it's a sign that the financier may soon take matters into their own hands and remove control of the company from the directors and place it into the hands of a receiver. If that occurs, generally key assets are repossessed, and it makes it difficult, if not impossible, for that company to generate future income. If that income stream is cut off, quite often we see that the companies end up in liquidation.
I suppose it's a spiral effect.
It is, definitely. Another indicator is where employees or a company's bookkeeper, accountant or financial controller themselves have raised concerns about the company's ability to meet and continue to meet financial obligations. Directors quite often do bury their head in the sand, ignoring cash flow issues, hoping that they will eventually sort themselves out. However, those people around them who are not as necessarily as financially invested in the business quite often notice things that aren't working as they should. People close to a business who know how it runs have concerns about how things are operating, then there is almost certainly a solvency issue brewing in the background.
See some colourful emails.
Yes,
Ash?
definitely, between employees and their bosses, particularly if they are working for free because they haven't been paid for a few weeks. So for the accountants and lawyers out there, it's important that you look out for these types of indicators and to make your clients aware of them as soon as possible, as they will rarely identify these issues themselves and seek the appropriate advice from you. Okay, so along the course of our appointments, we are quite often greeted with many insolvency myths out there that get carried around as like Chinese whispers. So we thought we'd take some time today just to go through some of those insolvency myths and to debunk them once and for all. The first of those myths is an oldie but a goodie, where the ATO gets priority for its tax debts. So prior to 1993, that certainly was the case. The ATO was a priority creditor and a winding up. However, since that time, all debts owing to the tax office rank equally with other unsecured creditors, with the exception of unpaid superannuation guarantee charge, which still gives the ATO priority over ordinary unsecured creditors. And generally they rank equally with employees for their wages. Insolvency myth number 2, insolvency practitioners always get paid first. Contrary to what people believe, insolvency practitioners don't get paid first, and quite often we just don't get paid at all. Particularly in the likes of court liquidations and bankruptcies, the first payments actually go back to the creditor who petitioned for the court liquidation or bankruptcy in the first place. And those costs incurred by that petitioning creditor rank even ahead of the insolvency practitioner's remuneration and disbursements. In addition, secured creditor amounts owed can also rank ahead of liquidators or bankruptcy trustees' costs in certain circumstances where they have a registered security over particular assets. The only costs in that instance that the insolvency practitioner is entitled to receive ahead of the secured creditor is the costs that the insolvency practitioner has incurred in securing, preserving and realising those assets. However, in the case where there's no assets available and there's no other potential recovery actions that are being pursued by the insolvency practitioner, the practitioner still has obligations to undertake a certain level of investigation and to report that their investigations to ASIC and various other statutory bodies. They do that without being paid and without the ability to be paid, and they're required to do so. However, in cases, and we have been asked quite a number of times by creditors, they would like further investigations to be undertaken, more detailed investigations to be undertaken, even if there are no funds available to meet the costs of doing so, liquidators will consider doing those more detailed and specific investigations. However, it's not uncommon for them to request funding from creditors to help with the costs of undertaking those further investigations. Insolvency myth number 3, if my company goes into liquidation, I will go bankrupt too. So a lot of company directors are under the impression that liquidation of their company means that they automatically become a bankrupt themselves. Whilst that does occur more often than not these days, it should be noted that the personal financial affairs of the director are separate and distinct from the company. So the bankruptcy of the director themselves is not automatic, and it entirely depends on whether the the director has provided personal guarantees to the creditors of the company. And so one of the first things we advise directors when we get appointed is just to have a look through records to determine which creditors they might have provided personal guarantees to, because they're the creditors that are likely to pursue them and pursue bankruptcy of them in the coming months after liquidation. Something else to think about for directors is where a company hasn't been completing their necessary PAYG and superannuation lodgements with the ATO. It is likely that the director is already personally liable for some of the company's debts. In that case, the ATO can and is more and more frequently issuing director penalty notices to directors pursuing the personal liability. And that happens now even after the company has gone into liquidation. If that occurs, the director's only option for removing their personal exposure is by paying the amounts owed to the tax office. Insolvency myth number 4, administrators and liquidators work for the directors. We hear this quite a lot, surprisingly, generally from creditors who are a little bit disgruntled that they didn't know that the administration or liquidation was coming, who don't understand the process fully. So to clear that up, although an insolvency practitioner may be appointed by the directors of a company, which occurs generally in a voluntary administration, or if they're appointed by the company's shareholders, as in a creditor's voluntary liquidation, then the practitioner is still bound to act in accordance with the Corporations Act, as well as various other statutory bodies. But it comes down to a simple fact that they are there to act in the best interests of all creditors. Independence is very important, and an insolvency practitioner is required often to report on matters of independence and actual or perceived conflicts that arise. In contrast to that, a receivership is where an appointed receiver is generally working for the appointor, such as a bank or other financier. So in that particular instance, the bank or financier engages them to recover assets or take control of the company, depending on the security document. And the insolvency practitioner's sole responsibility in that case is to recover the assets covered by the security and to report back and pay dividends to the bank or other financier. And in that instance, they're not required to deal with ordinary unsecured creditors. However, I reiterate that despite the type of appointment or how it arose, the insolvency practitioner is appointed to act in the best interests of all the creditors of the company. This can and often does mean taking action against the director for breaches of the Corporations Act, including insolvent trading, even if it was the director themselves who sought the appointment in the first place. Insolvency myth number 5, if I go bankrupt, I will lose everything. Well, bankruptcy does impose a fair amount of restrictions on a person. However, there are certain items of property that a bankrupt is entitled to retain, and this is what we term non-divisible property. So, for example, a bankrupt can usually retain a normal amount of household furniture and clothing, items of a sentimental nature, tools of trade, particularly if they're, say, a plumber or electrician and they require these tools in order to generate income. If they're under a certain value, then we tend not to, or we're not able to recover those items. And if they are above a prescribed value, which I think is around about $3,600 at present, we generally negotiate with the bankrupt to pay amount into the estate to essentially buy those tools back. And the same happens in the case of a motor vehicle. They can have a motor vehicle up to $7,500 at the moment. Anything over that, they tend to enter into payment arrangements with the the bankruptcy trustee, in order to buy those assets back, or the equity in those assets. There's other items that the Bankruptcy Act specifically excludes from being divisible in a bankrupt estate, and mainly those items are superannuation and the proceeds of personal injury claims or wrong done to a bankrupt. But note should be made here that where a bankrupt has deliberately been paying money into their superannuation fund to ensure the creditors don't receive it in the event of bankruptcy, those types of transactions are reviewed and often reversed by a bankruptcy trustee so that the funds can be recovered for the benefit of the bankrupt's creditors. But for that to occur, then there really needs to be an intent to defeat creditors, and that's the underlying issue. But from personal experience, we see a lot of bankrupts whose lives are relatively unaffected by bankruptcy. They continue to work, generate an income, even in some instances go on holidays when a family member pays for them to do so. A number of our bankrupts actually work overseas, so they still travel quite extensively. So in a lot of cases, bankruptcy, you don't lose as much as what the general public thinks. Being a director of a company in liquidation restricts me from being a director of other companies. This one's not so commonly seen, but nonetheless, a person basically can be a director of as many companies as they want to be, with the exclusion, if you are an undischarged bankrupt, you are disqualified from managing a corporation. So in that instance, you aren't able to be a director. But provided that's not the case, there's no restrictions on the number you can be a director of. And that automatic disqualification, if you do become bankrupt, applies not only to undischarged bankrupts, but also to those individuals who are subject to personal insolvency agreements under Part 10 of the Bankruptcy Act. There are a few rare cases where the court has granted an individual permission to still act as a director of a company, even though they are subject to administration under the Bankruptcy Act. However, once a person is discharged from bankruptcy, they can be a director again, and that applies also to individuals subject to personal insolvency agreements once the terms of their agreement have been fully complied with. In addition to being automatically disqualified, ASIC also has the power to seek a banning order against a person from managing corporations where they have been involved in 2 or more unrelated failed companies. And as insolvency practitioners, we are often reporting to ASIC cases we identify where directors have been directors of 2 or more failed companies, and they clearly are abusing the process themselves, and then ASIC determines whether they will take action to suspend or disqualify that individual for a period of time. Myth number 7, a bankrupt cannot operate a business. This one we do hear quite a bit from undischarged bankrupts. Some think that they're not able to have a job, particularly if they've been a sole trader in the past. However, it's absolutely possible for a bankrupt to operate a business. We're not in a position to deny anyone the right to earn an income. However, there are restrictions placed on individuals who are bankrupt and wish to operate a business, and those largely are that they must trade under their own name, or if they trade under an alternative name, like a business name, they must inform everyone that they deal with that they are bankrupt. And this is something that we're seeing a little bit now. Bankrupts are continuing to trade, but they're failing to tell those that they deal with that they are actually an undischarged bankrupt. And in that case, it's actually an offence under the Bankruptcy Act, which we report to the Australian Financial Securities Authority. As well as the above, there's also no restriction on a bankrupt actually obtaining credit. The only obligation that they have in that regard is if they are seeking funding from a credit provider, that if the amount that they're seeking exceeds the prescribed limit, which is currently $5,360, they are required to disclose to that financier that they are an undischarged bankrupt. Again, if they fail to do that and the bankruptcy trustee is made aware of that, they report that offence to the Australian Financial Securities Authority, who then considers prosecution against the bankrupt. Insolvency myth number 8. If I put my company into a pre-pack administration, I can buy it back cheap without its debts and creditors. This scenario is one we're seeing more and more frequently these days, this pre-pack administration. For those who mightn't be aware, a pre-pack administration is essentially where a valuation is taken of the business at a particular point in time. The director sets up a new business, and through that new business buys back the assets, or buys the assets of their original business for a value, and continues to trade under the new business without all of the old debts and creditors. However, there is a misconception that the director can actually buy those assets basically for a bargain and continue trading without any of the obligations they had. Unfortunately, they still need to obtain a fair market or pay a fair market price for those assets. Otherwise, what happens is a liquidator appointed to the original business comes along and determines that the transaction where they haven't paid market value is an undervalued transaction, and they seek recovery action against the director for the extent of the shortfall or the underpayment that they made. So advice in the case of those thinking about a pre-pack administration is to ensure that an independent valuation of the business is sought, and that market value is paid by the director, and this should alleviate any issues with an undervalued transaction in the liquidation of the original entity. Something else to note is that whilst a director may pay market value and set up a new company trading the same business, it doesn't absolve them of their duties to the creditors of the original company. And if they traded that company whilst insolvent, they can still be held personally liable for debts incurred during the time that it was insolvent and those that remain unpaid at the date of liquidation. Number 9, I can pay off some creditors before others as I promised them their payment first. We see this less and less these days, but essentially what the issue that occurs here is that some creditors may receive a preference over other creditors, and in that event, if they occur within a certain time of the liquidation commencing, then a liquidator can actually go and reverse those payments and recover those funds and distribute them to creditors on an equal basis. It is important, though, for a liquidator to be able to show that the payment was made purposely to put the creditor in a better position, and it's sometimes difficult to be able to prove this. However, if the preference payment is made to a related party, then the requirement for the liquidator to show that it was made purposely to put the creditor in a better position is no longer required. Where preference payment has been made to the ATO, these payments are actually quite frequent, and they're in relation to debts that are not given a priority. So for example, ATO debts that are not superannuation guarantee charge, so PAYG and income tax, for example, a liquidator usually does pursue recovery of those preference payments. But a point to note for directors, if that does occur, is that where the ATO has repaid a liquidator for a preference payment received, Section 588 FGA of the Corporations Act actually allows the ATO to pursue recovery from the director for any amount that they've had to repay to the liquidator. So it's very important that a director is careful making payments to certain creditors, particularly around sum amounts and those sorts of payments, where they suspect that their company might soon be wound up, particularly if they've got knowledge of a winding up application that has recently been served on them. And a final insolvency myth, the banks will never lend me money again after liquidation. That myth, whilst is true in some instances, it actually on a case-by-case basis. Banks will assess the situation and they will lend if they think the terms are reasonable. So in that respect, we really can't say whether they will or whether they won't. It shouldn't prohibit you from borrowing money, but it's at the discretion of the lender, particularly where the lender is aware that that particular director operated a similar company recently that's just gone into liquidation. Likewise, in the case of bankruptcy, whether a bank will lend to an undischarged bankrupt or allow them to retain a credit card will be entirely up to the individual financial institution. Often they do lend, however the terms and the interests are not as favourable as what they might have otherwise been, which can be difficult to meet where income is limited in the case of bankruptcy. So what do we do if insolvency is suspected? In the case of a director, our advice is to seek some proper accounting and legal advice as soon as possible. This increases the likelihood of the company surviving, which in this day and age, what we see more often than not is that directors are simply not seeking advice early enough. By the time they do seek advice, it's far too late, and there's little to be done other than have a liquidator appointed to wind up the company. It's important that a director doesn't allow the company to incur any further debts. Directors are potentially personally liable for debts incurred if they suspect that the company is insolvent, and ultimately a liquidator is appointed. A liquidator can look back as far as necessary to work out when the insolvency first occurred, and any debts incurred from that date forward, they can pursue the director for repayment of those. If it happens that the company is unable to restructure or refinance, or the shareholders or directors are unable to obtain any further equity to put into the business, they really do need to consider the appointment of a voluntary administrator or a liquidator to minimise their personal exposure from that point on. And particularly where a director penalty notice has been received from the Commissioner of Taxation, it's essential that the director seeks advice straight away, because there is a very short time frame in which to respond to those. Directors have the most to lose if they suspect solvency, and they need to take steps to seek advice on what to do. Shareholders, they may own the company, but the control of the company generally lies with the director. In addition, when a company does go into liquidation, shareholders rank behind the creditors. So it's very rare in this day and age, unfortunately, that shareholders receive any kind of dividend from an insolvent liquidation. However, if they have invested money into the business, they may be considered a creditor of the business, so they should seek professional advice as to whether they can lodge a claim in liquidation and perhaps receive a dividend. Once a company is in liquidation, a shareholder is unable to transfer any shares without the permission of the court or the insolvency practitioner appointed. In that instance, if a liquidator is appointed, the shareholders should seek some tax advice from their accountant in relation to whether any capital loss can be claimed once the company has been placed into voluntary administration or liquidation. In addition to the above, the members of a company can also request that a directors' meeting be held to consider the solvency of the company. In the event the directors fail to call a meeting as required by the members, then the members may do so themselves, so long as more than 50% of them agree. And failing all of that, the court can also be approached for assistance where it's required. For creditors and suppliers, initially, whilst it's a difficult conversation to have, these concerns should really be raised with the company that you're dealing with. Sometimes terms can be agreed between the parties as to how to move forward. But if this isn't the case, or those terms are still not being met, then really need to seek some legal advice as to what the issues are, and if necessary, you can go down the path of seeking a winding up of the company if your debt owed exceeds $2,000. This path can be quite expensive though, and what we see is a lot of creditors don't take that step, as they consider that they're throwing good money after bad, but essentially the situation won't improve unless one or more of the parties take some form of action. And finally, if there's an employee of a business who suspects insolvency, they should also be raising concerns with their employer, as difficult as that is. And it is surprising how many employees we see who continue to work for a company despite not being paid superannuation for a considerable period of time, and in some cases also not being paid wages for a period of weeks. In that case, they can also lodge complaints with the ATO regarding unpaid superannuation. They can contact union members or Fair Work Australia if they have concerns about non-payment. There's also the option of speaking with ASIC and lodging a complaint against the directors of the company. But again, legal advice is essential if the issues are just simply being ignored. Well, everyone, that's all we have time for today. For those of you who may have sent in questions, we will be emailing you a response shortly. But otherwise, thank you all for your attendance and have a lovely afternoon.
Thank you.